Hello and welcome. You're watching India Market Open. It's Thursday and it's looking pretty rough after yesterday's sell-off. We're waking up to marginally flat to slightly higher implied Nifty, but globally as well. Niraj, US hasn't done too well, but of course for the month it's actually had a fantastic month. Asian markets also a little edgy this morning.
Yeah, and the Japanese data also that came out, the factory output not that great. So in some sense the funda Q is not that great. But Samina, the question, have we kind of fallen quite a bit relative to what the Qs would have necessarily anticipated? I mean, that remains the key question. Yeah,
and I think the lack of Qs and triggers over the last couple of months, or couple of weeks rather, remember the markets have been very sideways. So this advisory from the AMFI did spook the markets yesterday. We'll talk a little more in detail about that as we go along through the show, whether it's an advisory, but I think quote unquote, Niraj, it is to protect retail investors. Ultra HNIs know exactly risk management. It is retail investors who invest in stocks on back of past performance is what it is. But I think the industry as whole has said this is actually a step in the right direction. Warnings are good. The word froth being used might not have been great.
Yeah, you know, so I don't know, somehow I have some I don't know, fairly strong thoughts on this. So this SEBI warning for small caps, right? And what SEBI has done is what Samina was referring to, which is directed mutual funds to protect small cap investors from quote unquote market froth. Now, you know, SEBI warning is not the first and the only warning that has come out. People that me and Samina have spoken to all through the last 3 months, there are various people who cited that there seems to be some bit of, valuation bubble, if you will, at the small cap space. It's on the first warning. Does it make the whole space uninvestable? Very likely no, because there are a lot of smaller sectors which are actually great, but it does bring the attention squarely back to the small cap space and people who are betting ad hoc on small caps because there are a lot of new investors in the market, so maybe that serves as a purpose as well. And I don't know what your thoughts are, Samina, but maybe lump sums in select cases may see a pause, but SIP flows, which have been very strong, they will continue.
In fact, I heard what the SBI fund manager was saying, and he said since 2017, their small cap fund has actually stopped taking lump sum investments. And this is 7 years back. So it's not like things have changed. And the other thing, a very valid point, I thought, they said liquidity could be a concern if, God forbid, there is a redemption pressure that comes in. But the fact is, the liquidity also for these companies has improved substantially in the last 3 years. Micro-cap companies have become small cap. Exactly. Small cap has become mid-cap. And some of the mid-caps have become almost large cap. So liquidity has improved while it has been seeming like a bit of a froth, like the regulator said. But I think that was the word. I think that's what's spooked the markets in that sense. But generally speaking, most people believe this is a warning and in good time. You know, this is much needed. Don't forget that the Nifty small cap index is up 71% in the last 52 weeks. The Nifty mid cap 100 is up 64%, and this is far greater than the Nifty itself that gained 28% in the last 1 year. Well, it could be some bit of spooking for mid and small, but I'd imagine the large cap guys would be fairly excited because the money will have to be rebalanced and flow back into large cap space. We've been waiting for FIs to do that, but it seems like the regulator might encourage DIIs to do that itself.
Yeah, who knows? That may well be the case. And remember, large cap funds had a good flow number last month, so let's wait and watch how that shapes up. Sorry?
I'll just quickly do the global check and then we can go back into...
Most certainly.
Yeah, so I'll just take you through what's happening across global markets. But let's pull up the implied Nifty first, right? Get a sense of what we're gearing up for this morning. Remember, it's expiry. Feb has not been too bad a month for the markets. In the last 3 years, this is the very first time Feb will potentially be ending the series on a positive note. After a 1% fall, a close below 22,000, the implied Nifty is indicating to a marginally flatly higher start. May not last too long, let's put that out there as well, and that's largely because global Qs aren't looking very strong either this morning. Asian markets are all over the place, if I may say. They're trading flat to slightly lower. Japanese manufacturing data once again contracted. That doesn't seem to be putting off investors in that sense. You also had commentary from the Japanese Japanese central bank saying that they will be watching out for the volatility in the Japanese yen. Now, remember, Niraj had indicated that the massive rally in Japanese equity was also backed by a lot of foreign flows coming in on back of a weaker yen. A stronger yen has never garnered well for an export economy like Japan, and the regulator taking cognizant of that and saying that they will, in more ways than one, manage that currency. Well, that's of course Asia. Apart from that, you've got some Chinese data that's also weighted, so the markets will be watching out for that. Shanghai is up and about. It seems like it's the only market that's decoupled from the rest of the world, while the rest of Asia looks down. It's China that looks positive, and Hong Kong, of course, follows suit. Apart from that, Wall Street ended flat in overnight trade. Nothing much to write home about. It's been a good Feb for those guys as well. AI-driven rally that they're calling it. The S&P 500 has clocked in pretty sharply. The Nasdaq is up 5% for Feb. The S&P is up 5%. And the Dow is up 2.1% this month so far. So it's been a pretty good Feb for those markets. And if Dow closes Feb in a positive note, which it is expected to, it's going to be the very first time that the Dow has seen 4 straight months of gains since 2021. So lots of history being created. And talking about history, remember the days when we talked about Bitcoin not really being a real asset class. Much has changed since then. Bitcoin continued its rally upward, made a fresh high of $64,000 before turning lower in trade. It ended the day closer to $62,000, but of course off from its intraday high. Remember, there is the April halving meeting that's expected, and spot Bitcoin could be making an application there, on back of which a lot of traders, investors are bulking up on Bitcoin. It's gained over 200% since November 2022. So, Niraj, we talk about equity, we talk about the Dow, we talk about the Japanese markets, we talk about Indian equities, and here is not even an asset class that was considered legit 3 years ago that is drawing enormous amount of attention. And from what I believe, despite these rises, there is no profit taking happening at higher levels. In fact, any sort of short positions are getting filled up pretty swiftly.
Yep, it's certainly doing the right things. Let's wait and watch where does this rally end, if you will. 64,000 on last count, I mean, at least the highs. Let's see what happens until the halving day. Remember, the date is not exact, but somewhere around April. Just one quick word on what the U.S. markets will watch out for tonight. The personal consumption expenditures reading for January comes out later today. And I think from an inflation gauge perspective for the U.S. markets, what to watch, that's the point I was trying to make for the U.S. markets. The personal consumption expenditures reading, so that is important for the month of January. Economists are factoring in a 0.3% monthly gain and a 2.4% YOI move. A print higher than that could be rough weathers for equity markets. But speaking of equity markets, yes, weak global cues, and that could maybe weigh in. I mean, when I'm thinking of the trade setup, the weak global cues could certainly weigh in on the buy the dip strategy that has been there for such a long time. But frankly, when I look at the high frequency indicators, VIX is already at the higher end. Typically, it's range between 14.5 to 16.5, already at 16.33. So VIX is higher, and even quant data is actually so VIX is higher, and which is fine. But quant data is suggesting that there is no large sell-off possibility. So that's one thing to keep in mind. And the PCR, the Nifty PCR has fallen to 0.66. Now, usually, it was at 1 yesterday. Usually 1.4, 1.5 is when it indicates that there could be rough weather. We are at 0.66. So I think the PCR indicates that there's no substantial sharp sell-off possibility despite what happened yesterday. So that's part two. And when you think of sectors, yes, all the sectors otherwise which have done well are in focus. But keep a keen eye out for autos. The monthly numbers for February come out tomorrow. I was remembering the City note on Maruti, which had said that Maruti is expected to come out with some very good monthly sales data. But passenger vehicles and two-wheelers in particular are the pockets to watch out for from a monthly sales data perspective, which comes out tomorrow. Let's see if there is a bit of a build-up into passenger vehicles and two-wheelers in the session today. So those are the two pockets that certainly should be kept in mind in the session today.
Yeah, and just a quick one on the numbers. So as expected, FIs sold in the market yesterday. DIs continue to be net sellers. DIs bought to the tune of 1,827 crores, while FIs sold a little more than that, 1870 crores in yesterday's day of trade. That's pretty much been the trend over the last couple of weeks, so no guesses of why that happened yesterday itself. A quick mention on the F&O ban list. Indus Towers and SAIL have been added to the F&O list starting today. Aditya Birla Fashion, Canara Bank and Z finally are actually out of the F&O list. And you can look at the implied Nifty. It's actually eased off already in the last 5-6 minutes. So very likely that we might actually see a flat to slightly lower start in today's day of trade. Well, a bunch of stocks to watch out for. Reliance is on top recall. It's been one of the top losers. Actually, Niraj, you might want to come in on this one before I talk about the Reliance Disney merger. The stock took it to the chin yesterday, down nearly 2% in trade. It led the fall on the Nifty 50. I know the likes of Adani Enterprise also declined. But was it just basket selling, or there was something specifically that happened?
The two banks as well, HDFC and ICICI Bank, also out there. So
it's the banks and RIL.
Yeah, it kind of seemed like that, to be honest. A bit of.
And it shouldn't have for any fundamental reasons, because a deal they've struck with Disney, of course, is worth noting. I'll quickly highlight that, and then, of course, Niraj can add his perspective on that too. Reliance and Disney, and this was unexpected, lines have merged, will merge respective digital streaming TV assets in India. RIL is expected to invest 11,500 crores in this joint venture. Disney is to provide the content license to the JV, and the transaction values the JV at 70,352. Neeta Ambani will be the chairperson, and Uday Shankar will be the vice chairperson. This is interesting, Niraj, because they've got this at a deal. I mean, Star India, I believe, was valued at 15 billion in 2018. This is at the time of Disney's acquisition of the 21st Century Fox. Considerably reduced down to $3.2 billion in the last 7 years. And most analysts on the street believe it was RIL's negotiation skills that drove the valuation of Star down to where it has been. And for good enough reason, because if you look at numbers, if you look at everything else, it's actually not doing too badly for the business, apart from RIL negotiating this deal and taking lead.
Yeah, I mean...
it's a power play.
Yeah, and the fact that they lost a lot of streaming clients. Hotstar did, because of the IPL streaming rights going away. So the last estimates as of last week, as per the Reuters story, right, what $3.9 billion for Disney. It's now come in much lower than that as well. So in that sense, it's a bit of a shoe-in. But there's a larger implications, maybe not as much for Reliance. I mean, I don't know how much would this do to Reliance's overall numbers, because it's a large balance sheet out there versus what this entity might be. But could it have a play on maybe a Network 18, a Sun TV and some of the others? Because could they muscle in onto some bit of pricing moves with regards to ad rates, etc. GECs more so than News, to be honest, because News is Network 18, which is now a separate entity. This is Viacom 18. So maybe GECs could be an interesting one. And let's see if there's a reaction today.
So stock impact would be visible on what counter you'd imagine?
I would reckon, I mean, maybe. This whole talk of how Network 18 through Viacom 18 will benefit probably goes out of the window completely. Maybe some negatives for the other GECs. I, for the life of me, can't imagine why would this really make Reliance start looking very attractive. It's such a small pie in the overall scheme of things.
Yeah, you're right. It's small, and that's the giant. I guess sentimentally this could be, though, viewed as a positive. So that's the RIL Disney. We will, of course, over the course of the day, talk to brokerages, understand how they're reading into this. It's also going to be interesting to see what it does to Z, not because there's any direct correlation on this one, but the bad news for Z has been so intense that the stock comes out of the F&O ban today. With good news from another counter, this might actually dent traders or investors looking at media counters. Well, the other one that we've talked about is going to be UPL, and you've got Shriram. Both those counters in focus. Shriram Finance is going to be replacing UPL in the Nifty 50 index on the 28th of March. Shriram's 6-month average free float market cap was highest as UPL's replacement. So this is one stock you want to watch out for. Shriram Finance, more than UPL, will be seeing a reaction to this news this morning. A quick mention of PNB, Punjab and Sindh Bank. They've also announced they're looking to raise 2,000 odd crores via equities and bonds. The amount will be raised in 1 or 2 more tranches over the next 12 months. No immediate fundraise, but that's the roadmap for the next 52 weeks. PB Fintech, this one's been quite active in trade. It's been catching my attention pretty much watch every other day. Yesterday as well, on a down day, the counter was up 2.5%. It's up 30% for the month. IRDAI has granted registration certificate to the company's Unit Policy Bazaar Insurance Brokers. With a new registration certificate, the category has been changed. So that's why you're watching out for PB Fintech. Could be another strong morning for the counter in trade, Niraj.
Yep, certainly watching out for all of those. I mean, just reiterating UPL and Shriram Finance as well. We spoke about this yesterday, about the possibility of the Shriram Finance inclusion in Nifty 50. Now, traditionally, or not traditionally really, I wouldn't call it a blanket thing, but at times it's been a winner's curse and a loser's gain to be booted out of the index as well in certain cases, though Z kind of doesn't quite fit that bill. But in the past, HPCL was booted out of the index. Look at what the stock did then. So it's not necessary that this would necessarily be bad for UPL and good for Shriram Finance. Maybe good for Shriram Finance, yes. May not necessarily be as bad for UPL because, frankly, the stock has been beaten down so much, because of which the stock has been booted out. At some point of time, the fundamentals may change, and that will be the driving factor. But sentimentally, a positive for Shriram Finance today and a negative for UPL, I'd imagine. So kind of watch out for those as well. NTPC. Now, previously, I thought it was NHPC which has signed this deal, but it's not NHPC, it's NTPC, wherein the unit has signed a JV agreement with Maharashtra State for developing renewable energy parks. For NHPC, it might have been a big thing. For NTPC, looking at the size of the company, may not be as big, but keep an eye out for this. Keep an eye out for Venus Pipes. That's the other one in focus. And there are some brokerage calls, Samina, but I don't know if you have other stocks, but Venus Pipes could be interesting because now that they foray into the fittings business, fittings is usually the higher margin business. And for all of these companies, they have a set of dealers already established. So it's relatively easy to sell what they are getting out to. Now, if Venus Pipes succeeds, this could be construed as a positive because it's a higher margin business and therefore the multiples may change a little bit. So do watch out for Venus Pipes as well.
Just very quickly, only because it's a morning that belongs to the regulator. They've actually, SEBI has issued a warning, pulled up ICICI Securities, and they've said that they have, of course, pulled them up in connection with the inspection of books and records of the merchant banking activities of the company. ICICI Securities had said that the admin warning will have no impact on its financial, operational, or other activities of the company. Sentimentally, though, this might be a negative. You might see the stock coming under some pressure. Apart from that, Jubilee Foodworks, the trading of shares of DP Eurasia, which is a step-down subsidiary of the company on the LSE, which is the London Stock Exchange, was also cancelled by the Financial Conduct Authority on the 28th of Feb. So now you watch out for this one because Jubilee could be facing a little bit of heat on this one. BGR Energy, we'll of course talk about block and bulk deals later on in the show, but the promoter Sashikala Raghupati continued to reduce stake in BGR Energy Systems, sold about 6%, followed by 2.5%. So this one is another important one that will be in trade. And KSB, they reported earnings, which we will talk about later as well.
Yeah, just a brokerage call before we head to editor's cut. So JSW Infra is in focus now. Motilal Oswal has made it a habit of making stocks react. I wonder if JSW Energy also reacts. Infra also reacts. JSW Energy, incidentally, has a sell rating from Citi, by the way. But JSW Infra is the stock in focus. They've initiated with a buy and a target price of 300, which is about a 22% upside as per the brokerage, or as per the closing price yesterday. They value the stock at about 18 times FY26 EV EBITDA. Now, why do they like it? They expect the company to clock in a 19% volume CAGR. And this volume growth of 19% CAGR will drive, according to them, a 21% revenue CAGR and a 25% EBITDA CAGR. 25% EBITDA CAGR under any circumstances for 3 years is a good deal. Now, this is the same assumption or similar assumption made for Dreamfolks yesterday, made for Cello World the day before. I'm not saying, therefore, JSW Infra also will have a 5% reaction, but that's been the trajectory for the last 3 days, so keep an eye out for those.
It's an edgy morning. I don't know whether a 5% on that.
Yeah, but remember, on a day like yesterday, Dreamfolks ended up 5%.
That's true.
So,
okay, so
that did well.
We will watch with caution. This one could see a gap up. Just a quick one. GPT Healthcare list today on the exchanges. The final price has been fixed at 186 rupees a share. And also in that same breath, Junai Hotels, which of course saw a listing. Norges Bank, on account of the government pension fund Global, has also bought a stake of 0.98% into this luxury hotel chain at 398 rupees a piece yesterday. KSB, like I said, reported numbers. They reported a profit of 54 odd crores. Down, but they've declared a dividend. Operating margins were weaker, but top line didn't do too badly, Niraj.
Yeah, just on GPT Healthcare, remember, subscription was 8.5 times. So let's see what's the kind of reaction that we see. It may not be as muted as Juniper Hotels yesterday. But, well, that's it on the trade setup. It's over to Agam. And Agam, amidst a slew of news, we try and talk about one space or one stock, which has been in focus for so many days now.
Yes. So we're talking about a giant where a lot of investors will stick to through thick and thin, swear by, and that's Asian Paints. But what's also very interesting is that in the last 6 months, Asian Paints has come off by as much as 20% from its life highs of around 3,500 rupees per share to 2,800 rupees per share, even as the Nifty currently trades at around near life highs. And something, of course, has changed. It's not only because there's a new challenger in the space, but also perhaps several other challenges coming through. So we are going to talk about Asian Paints in Editor's Cut today, but we're also going to talk about, well, the new player, which will also be in focus. But I'm going to start off with Asian Paints, Niraj.
Strangely, while me and Sajid are presenting the bull and the bear case, in some sense, both of us, our views kind of match on the point that what's happened in Asian Paints, Sajid, I'm taking this liberty, that what's happened in Asian Paints, stock price move down, is not necessarily, one, restricted only to Asian Paints, and two, it's happening not because of any danger to its numero uno status, but because multiples were high, because ratios might come off a little bit. So I think all of that comes into play. So let me try and play the contrarian. And after this relative 18% or 19% relative underperformance to the Nifty, what's ahead for Asian Paints? I'll try and dwell in on that. You and Sajid, feel free to come in as and when you deem fit. So Q3 highlights. Asian Paints knew about all of this happening, but at the end of Q3, in the con call, the company's maintained its commitment to a double-digit volume growth trajectory on a 4-year CAGR basis. So they are confident about volume growth, independent of what the competition may look like. That is part one. The home decor business is 4% of revenue. It's targeted to reach to 8 to 10% by FY26. Why this is important? Because they're routing home decor as well through dealers, as one of the dealers told us yesterday on a call. And that actually strengthens the dealer network confidence and association with Asian Paints. So that's part two. They have maintained the EBITDA guidance of 18 to 20%. So no chinks in the armor there either. Okay, so that's one. And and then I'll ask Sajid, Agam, with your permission, to come in with the bear case as well before I get to the numbers. But here's one thing. There's so much talk about what Opus entry could do, etc. Now, Asian Paints has faced competition in the past from Sherwin-Williams, AkzoNobel, reinvigorated Berger Paints, etc. It's not dented that. And when I looked at the Macquarie note on the paints sector, now Sajid, of course, would have more insight here because he visited Panipat and he was right there. But the Macquarie note states that Grasim is targeting 1,000 crore net sales post 3 years of full launch and positive EBITDA as well, right?
10,000 crores.
10,000 crores, okay, 10,000 crores, which makes them believe that the discounting pressures will not be as high, because if Grasim has these stiff targets, they'll not be able to go out and do a destructive pricing strategy, which may disrupt the paint space per se.
So let me come in here. The point is, paint segment as a whole was a sleeping segment with Asian Paint more than 60-65% market share in there. To wake up the giant, you need to have another giant coming in, and that's what has happened in the case of in the paint segment. You're coming in with some 10,000 crores of investment spread over next 2 to 3 years, which, if you look at the next 3 or 4 players, have not put together. So there is a focus on saying that it's a shock and awe kind of thing which is happening in this space, and that's why we are also discussing, because there's so much of big thing which is coming in. Capacity. Look at the model of Asian Paints. It's a perfect model for a monopoly, but the competitor is also has a similar model which is there. Now, no one is saying that Asian Paints will not be the numero uno. It will still be the largest player, but the opportunity which is coming in here for the new competitor is nearly 20,000 crores of unorganized market, which is not
precisely. So is it Asian Paints share that it will dent, or will it dent the others?
So the thing is that the pricing pricing does not play a thing at the upper end of the decorative paints.
Right.
It's not as elastic. It's inelastic in that sense. But it plays a very big role in C towns where, people are using distempers, they can go into enamels. The economy, the mass product which everyone is producing at the bottom of the funnel, that can move to an economy, and economy can move to a premium based on the pricing. The point being that the dent which is going to happen is at the bottom of the pyramid for all paint makers, including Asian Paints.
Okay. Right. Now, so Agam, but my contention is this, right? I mean, you've been patiently listening and siding with Sajid. I take offense to that.
No. So actually I've not been siding with Sajid. All I'm trying to say is that firstly, there's plenty of space for everyone to grow. And there's no doubt, no one is going to question Asian Paints numero uno position even 10 years down the line. That's not even this thing. But, there was a statement made by K.M. Birla, and he said that at the moment, the consumption of paints per person stands at somewhere around 3.5 kilos. As compared to a developed nation, which stands at 25 kilos per person. So there certainly is a lot of scope for growth. The only thing that changes perhaps with Opus's entry is that it maybe shifts things for people like Berger Paints and Kansai.
Thank you. Now that's the point, right? The topic of our debate today was what? Is the correction in Asian Paints overdone? Now let me present some numbers, guys. Yes. Asian Paints P multiples. This is as per the Motilal Oswal note. FY24, 25, 26. 47 times FY24, 45 times FY25, 41 times FY26. Now, lest you think that these are expensive numbers. By the way, the numbers on your screen, viewers, are as per a Motilal Oswal note. Now, if you look at the consensus notes, I'm just presenting what's happened in Asian Paints multiples all through the years. Now, what has happened in Asian Paints since 2012 or thereabouts? Look at this data, guys. Asian Paints P multiple in 2012, March 2012, was 31 times. Went up to 43 in 14. Went up to 55 times 2015. March 2019, 65 times. Went up to 95 times December 2020. Right? Had a dip of 71 times, maybe due to whatever factor. December 21 multiples were 105 times. The markets thought Asian Paints could do no wrong. From there, the multiples have come down to the current consensus numbers of 52 times. And if you look at the Motilal Oswal estimates of what could it do in FY26, it's 41 times. At 41 times, Sajid and Agam, Asian Paints is available at a multiple that it was last available in 2014. Now, has a correction in multiples happened or not? So it has, right?
Let me put a counter to it.
Please
you're looking from a market's point of view, you're looking from an investor's point of view, right? We're talking of 60 times, 50 times, and 40 times over the next 3 years or 4 years, which is there. Look at Grasim as a stock. It's getting a multiple for a VSF player as of today. Now, tomorrow it's...
but I'm not contending, Sajid, that Grasim may get favor.
Who's going to benefit?
Grasim may benefit. The question is Asian Paints correction overdone, Sajid? It's a marquee name with high ROCs. I mean, look at this. Look at the other statistic that I have, by the way, very quickly. The paints sector at large right now, right? Asian, Berger, Kansai, Indigo, AkzoNobel. I've taken 5. Allow me the ability not to take Grasim because Grasim hasn't proven itself thus far. It's a VSF player. Look at the comparative. TTM-PE multiples. Berger is actually higher than Asian, by the way, right? The others are lower. But look at the return on capital, right? Asian Paints is matched only by AkzoNobel. Every other player has ROCs and margins lower than Asian Paints. So my question only is, one, does Asian Paints deserve higher multiples? Yes, it does. Has it been a multiple uptick? Yes, it has, because the CAGR growth rates haven't been as strong as the share price uptick. So the valuation multiples have gone up. But from 100 times, it's come down to 41 times FY26. You can argue it is still expensive, but I can argue that relative to history now, it is way cheaper. And at some point of time, people will sit back and say that it's underperformed the Nifty by 20%. Is this overdone?
But what is the market saying because of this? With 20% which has fallen for Asian Paints, it's derated the valuation from 60 times to nearly 40 times.
Which
basically means that the market is seeing the growth is there, but the valuation may not be as aggressive going forward.
Right. So priced in.
Right. It's been priced in.
Maybe.
Now the next fact is that if there's a competition which comes in 3 years down the line and it brings in metrics which is similar to an Asian Paint, will it have a same kind of valuation?
Maybe Grasim gains, but Grasim has other things.
But it will be at the cost of who?
Well, I would dare say, sorry, the last piece that I have, I would dare say that Grasim is saying that we want to be number 2. Would Grasim displace the number 3, number 4, number 5, or the number 2, number 3, number 4 currently, and not Asian Paints on the multiples front? I rest my case.
No, I'm not saying whether Grasim becomes number 2 or number 3. The point is that today there is a challenger who is saying that I want to become number 2.
Exactly.
It has never said that I want to replace Asian Paints.
Exactly.
But point is that how is it going to do it? It's going to do it through taking away the market share of 2, 3 and 4.
I'm saying is that in the price for these companies.
And the bottom of the pyramid of Asian Paints. And that's where. So if Asian Paint is tomorrow able to prove that, okay, I'm going to go into the high-end paints and that's where the higher margins are going to be, then maybe the valuation for Asian Paints will come back. But today, the base level, which is the of the pyramid, it's at risk for all the players.
Agam, these two argumentative Indians can go on and on. But I guess the verdict is whether Asian Paints correction is overdone. Right. I would suspect that a lot of it is in the price.
Sure. So, we do understand that at the moment, given the kind of correction that we've seen in Asian Paints and going at considerably lower valuations as compared to its historical valuations at which Asian Paints is trading at, well, there potentially could be some value in there, but we need to also consider that growth, considering the size at which Asian Paints is right now. Secondly, of course, with all the other players, well, pulling their socks up while we have Opus challenging for a number 2 position, at least in the near term. Well, a lot of these factors are going to be weighing on a lot of investors' minds, which is why possibly we have seen that correction in Asian Paints. But there certainly is an argument for value as well, because Asian Paints still does have significantly higher return on capital as compared to a lot of its peers as well. So a lot will eventually be clear as we move through the course of the next few months and years. But for now, it does seem like Asian Paints, well, perhaps just adds a little bit of value as compared to what it could in the previous few years. But on that note, it's a wrap on Editor's Cut. But don't go anywhere. I'll be back in just a bit to take you through all the F&O cues. Stay tuned and I'll be back in just a bit. Welcome back. This is India Markets Open. We head into an expiry day. I'm sure that there will be a pocket in the market which will be rubbing its hands. On the other hand, there'll be plenty of traders out there who will also be nervous, especially given the kind of cues that we saw on the benchmarks yesterday in the second half of the session. It was a tough one too, and perhaps traders were only thanking the stars that it wasn't an expiry, because it could have been a lot more volatile as compared to what we saw yesterday. That said, today may not be very different. But I'm going to start off with the kind of cues that we are seeing on the Nifty. And we did see the Nifty come up around 1%. Rollovers have begun taking shape, but perhaps the complexion of the market has changed towards a little bit more red at the moment. And some of those rollovers could potentially be towards the short side. Of course, we're still awaiting cues from today. Today is a day where the majority of rollovers come through. That said, this is your March futures, and of course, we are starting to see a little more build-up coming through. As far as the Bank Nifty goes, and it is also the Bank Nifty options as well as the futures expiry. This is, of course, the Feb futures. We saw a decline in about 27%, but March futures, again, saw a significant up move, an increase there and this what potentially could be shorts at the moment. Now, coming down the options market, naturally, since the Nifty came off, we also saw a lot of writing around calls and a lot of unwinding inputs. So specifically around the 22,200 mark, the Nifty has been trying to move above 22,200, and it hasn't been successful so far. And that perhaps will be a resistance today as well. On the lower end, we continue to keep an eye on around 21,900. And should that break, well, there could be some more issues, at least for the bulls in the near term. That said, in terms of how things are stacked up with respect to open interest, let's pull that up as well. And 22,200, as I was telling you about, that's the one with the maximum open interest. 22,000 is a pivot. And as far as the lower end of the spectrum is concerned, 21,500, that's quite a bit far away, but I reckon that when you do have that increased volatility, your max OI inputs also moves further away from current market levels because of that expectation in a sharp down moves. But coming down to the Bank Nifty as well, what range are we keeping an eye on? Well, it's a 1,000-point range. I know it's a lot, but it's actually just about 2% in total. So, well, 500 points lower and 500 points higher is what we're keeping an eye on. And of course, the 46,000 mark will continue to be a pivot in today's day of trade as well. It's something that perhaps a lot of traders would keep an eye on with respect to volume-weighted average too. Now, this is as far as your overall markets go. What are our experts suggesting that traders do? So, well, we have Aditya Arora of Analytics Research who's joining us on the show. Aditya, good morning. Thanks for joining in. Your view, one, on the intraday expectations of the market. Two, how would you positionally deploy yourself on the Nifty and the Bank Nifty going forward?
Very good morning, Agam. I think today's view is little, dicey because market is opening with gap up, but the kind of sell-off which we saw yesterday, I think if that pressure again builds up, then probably we are in for a good downside in the market. And if we go by the levels, then yesterday's low, if that is broken, and that is sustained, then I think there could be sell-off of more 50 to 150 points on Nifty. And same is true for Bank Nifty. We could see 0.5% cut in Bank Nifty as well if the lows are broken. So I expect 200 to 300 points of correction in Bank Nifty. And going forward, I think the outlook is bearish. We had discussed last time as well that to me the market outlook looks a little bearish. So if we position ourselves for March expiry, then I think yesterday's closing is pretty negative. So yesterday's spot closing is 45,963. So one must keep stop loss of 46,750. And target would be 45,000 to 43,000 in March expiry. So I'm pretty bearish on the market going forward.
Right. Aditya, so let's move on in the stock idea. I believe you have one on Reliance Industries.
Yeah. So the heavyweight started selling off yesterday. Today we have a positive news, but I think the patterns are bearish. So again, possibility of sell-off can happen post-opening. So in Reliance, 3000 call is sell for March expiry, which is trading at 49.80. Today we have a good news, so probably it could open gap up, but it's a sell from there. Stop loss would be 70 and target would be 30. That is call number one. And I have one more call which is on Titan. In Titan, we can sell 3,800 call option March expiry, which is trading at 36 rupees. Stop loss would be 70 and target would be 0.
You know, you've given us, naked sell call options. Now, I'm sure a lot of traders out there would be interested in perhaps getting a little bit more insurance. So if they were to perhaps buy those specific calls, at least in case of Reliance, how would you go about, well, perhaps adding a wing so as to limit your, up move?
Correct. So I'll add a wing for hedge. But I need to check exactly the price. But how this can go is that we can sell 3,000 call option in Reliance, and for protection we can buy 3,100 call option for protection. But the bias would be bearish. It would be a credit spread for us if we do it in this way.
Fair enough. And of course, credit spreads do work very well, just as well as you going ahead and selling the particular option. Of course, your losses, while the losses would limit your upside, your profitability would also be that much lower. But that said, Aditya, on that note, take a moment to thank you for joining us, taking us through your views on the benchmarks, as well as giving us a handful of trading ideas. And with that, it's back to you, Niraj.
Okay, thanks for that, Agam. So we'll watch out for some of these stocks as well. Bearish on Titan, bearish on Reliance, bearish on markets is Aditya Arora. We'll confirm with some of the other guests as well in the session today. But the big $8 billion Reliance Disney deal, Jinesh, Joshi, research analyst at Prabhudas, Lilladher, Johnson, to dissect what it could mean for some of the specific entities and the space at large. Jinesh, thank you for taking the time out and joining us. Good morning. How have you analyzed this transaction and the implications thereof?
See, this transaction basically will create a media behemoth, so to say, because if you look at the overall viewership share of both Viacom and Disney put together, it will be anywhere between 30 to 40%. Also, if you look at the size in FY23, collectively, both of them had revenues of approximately 24 to 25,000 crores. So obviously, I mean, the scale and size will be quite big. Also, to highlight that now with this entities coming together, you'll have IPL, BCCI as well as the ICC rights reside within it. So it will also emerge as a cricketing powerhouse. So net, obviously a big Goliath is about to kind of hit the street.
Okay. What could the implications of this be? Because back of the hand suggests that for Reliance, it may not be as big a mover, right? Relative to its size, this is not as large. 11% direct stake or whatever it is, or total cumulatively about 60% stake, not as large as maybe otherwise, and some of its assets get transferred. But what about the other media assets? Because I read somewhere that Dish TV comes into play now because Tata's buy into that asset from Disney. What the behemoth does to ad rates might have an impact on some of the other players in the GEC space as well. How do you sift through this?
So obviously, as I mentioned, if you have a 30 to 40% viewership share, your bargaining power will increase meaningfully. So all your ad rate contracts, you'll have a considerable bargaining power. Also, when it comes to the subscription business, very recently after the announcement of NTO 3.0, you saw some of the broadcasters increase their bouquet prices. Now, this can also happen with the merge co, because you'll have all the sports rights with you. You can create packs surrounding it and then sell it out. So that will also help you out. That again will increase the cost of entertainment. Again, I mean, if I talk about Jio Cinema, currently it is priced at about 1,000 rupees on an annual basis. And most of the sports content is not behind paywall. IPL was streamed for free. What they can do now is that they can perhaps put this content behind a paywall and increase the subscription price. So net, obviously, their realization will increase, and the cost of entertainment perhaps will set to rise from here on.
Okay. So therefore, does your rating on any of the stocks within your coverage, Jinesh, change as a result of the contours of the deal thus far that you analyzed?
Not really. Actually, I don't cover TV18 and Reliance. I may not be the right person to comment.
Right.
I cover Z PVR. But Z, I don't think, I mean, obviously there will be some implication because you have to now deal with a big player. But that will not lead to any material change in rating, so to say.
Okay. And just one final question, just wondering, for media players, you may not have direct coverage, but I'm just trying to get a broad brush view for media players like Sun TV, which have got this television streaming as well as OTT apps as well, or some others which may have these relevant pieces in this whole ecosystem. Could there be a case for caution in the near term until the strategy that this JV has kind of plays out fully and people know about it? Do you think analysts and investors would be cautious on some of those others?
Not really, because see, there is content diversity in the system. So if I talk about Z, although they may not have sports properties, but they are very strong in the regional markets. So the viewership base of India is quite diverse. Some may like sports, some may like regional genres. So what can happen is that one who has sports perhaps will have a better bargaining power, and they will try to kind of extract maximum mileage out of that. But there are certain other sections as well, which perhaps rely more on GEC content or regional content. And they also have their own OTT apps to kind of deal with the taste of other consumers. So I do not think there will be a wide gap in how the situation will emerge. But what will happen is that now everyone will have to deal with one big player, and that could perhaps increase the competition in the media landscape.
Okay. Jinesh, we'll leave it at that. Thanks so much for taking the time out and being with us and giving us your perspective. Really appreciate your time this morning.
Thank you.
All right, that's the view. May not be as much of an implication according to Jinesh Joshi because there's diversity in content and all may thrive. Let's wait and watch how this thing shapes up. So I think this will be an interesting one. Let's talk about life beyond just this deal as well. Vinit Bolinjkar, Head of Research at Ventura Securities, joins us right now with his thoughts on the fundamentals. And of course, in a bit, we'll also get in Shrikant, Chouhan to talk about the technicals. Vinit, good having you. Thanks so much for taking the time out. A bit of a flutter in the markets yesterday. Across the board, a bit of a corrective move. Global Q is not that strong either. Are you a buyer into some bottom-up ideas currently, or do you believe tactically there could be better levels?
Definitely there could be better levels, as we have been harping for the last month that Feb and March is a tax selling month, and people are transacting to get their books in order, booking their losses, reduce their tax liabilities. Additional to this is, we have seen a lot of paper coming into the market. There's a flurry of paper is unending, and as long as the SIPs were good, which they continue to be. But, the accidents that have been happening last time, we've had multiple accidents in the market in terms of corporate events. And that value erosion is somewhat matching the kind of SIP flows that are coming into the markets. So you have SIP flows matching accidents, you have paper coming to the markets, and you have FI selling increasing. So that's creating a lot of pressure along with the tax selling that happens. And I believe that the buying will be less and expect the market to trend down most of the month.
Vinit, how will buying become less? And that's what I want to understand from you. SIPs that are coming in every month are not going to start pulling back. I mean, I get a sense that while the broader markets may see a struggle, it's the large cap that has underperformed, and we were hoping that FIs would come and help that catch up. Do you think by this move or this warning by the SEBI could actually mean that liquidity will remain, the broader markets may see a decline, but the benchmark will actually start moving up? So it could be a gain for the large cap names, I'd imagine, because liquidity is not stopping anytime soon.
No, I'm fine with the liquidity. But as I said, the intent is on balancing your books. Okay, there are a lot of traders who have made handsome profits. They will be wanting to, apportion money for their tax payments. Okay, and when the SIPs come in, as I suggested to you, and you have market erosion to that much extent, okay, it has been happening for the last 6-8 weeks. That is creating a lot of balance at the margin. And when you have selling coming in, along the tax selling, as I mentioned to you, along with the FIs coming in, selling, it is going to create a kind of a slightly bias towards the sell side, and the liquidity is still remaining. I think that we will see much lower levels.
Right. Shrikant Chouhan as well joins in, VP and Head Equity of Kotak Securities. Morning, Shrikant. Thanks for joining in. Shrikant, how are you feeling about the markets today? I mean, things actually turned pretty sour this week. We were expecting it to be a week full of momentum on the upside, but it's actually not done too well for the bulls. With an eye on expiry today, where do you see Nifty expire? Is it going to be a sub 22,000 kind of Feb close?
Good morning, everyone. Yeah, I think, the market is facing currently a corrective sort of pattern because it is under profit-taking pressure. Most of the stocks which have gained substantially in the previous month, I'm going to say in the month of February, there we are seeing some correction. Like Reliance Industries was around 3,000 levels, from there all the way it is at 2,900. So it is all happening some profit-taking, and that's the reason we are seeing rollover pressure in the market, and the markets are down. If we go through with put-call ratio, then the markets are turning oversold. The put-call ratio of the current series, because in the next, a lot of positions are now shifting from the current series to the next series. But the current series it's deeply oversold. So if we see furthermore weakness in the first half because of any reason, then I think we should look for taking contra bets in the market. 21,800, 21,825 going to act as major support for the market. There we should look for taking some positions with a tight stop loss at 21,700 for intraday traders. On the higher side, 22,075, 22,100 will be resistance for the market. And I think the markets are going to remain between this range. That's the overall view. For the Bank Nifty, there also we can see some weakness, but I think 45,500 to 45,300 is the area. Again, around those levels, we can take some contra bets in the market. So broadly, we are of the view that the market is into corrective mode, and at important support levels, again, we should look for taking some contra bets in the market.
Right. In fact, the Nifty has tested 22,000 3 times now and has pulled back from those levels. So no real surprises there. Well, Shrikant, you want to give us your top trades, if you have any, for either the intraday or the March series?
Yeah, with a view of intraday or with a view of next 1 or 2 days, we should look for focusing on those companies where the trend is, or maybe these companies are relatively better than other stocks. So Indus Tower looks really strong at current levels. Even though the market was down, the Indus Tower was consistently holding above the level of 240. And again, there is a news flow. So I am of the view that till the stock is not breaking the level of 234, the stock can move to the next levels of maybe 255 or 260. So Indus Tower looks good at current levels with a stop loss at 234. We are also focusing on few taking short positions on few stocks, and in that we like IEX. The reason is because the stock is consistently forming lower top, lower bottom series, and especially on the day of expiry, we see furthermore correction in the stock. So at current levels around 140, 142, the stock is on the should be on the selling side. We can expect 133, 132 on the downside, and we can keep stop loss at 143 for the same.
Right, that's the trade. Indus Tower, remember that stock did quite well yesterday. And Shrikant got a constructive call on that one this morning as well. It is in the F&O buy list, but nevertheless, cash call coming in from Shrikant. We also have Varsha standing by with the other counters that are in the news this morning. Varsha, what do we have?
Good morning, Samina. So I do have 3 stocks on my list, starting with Venus Pipes and Tubes, wherein they've announced its foray into fittings business with a capacity of with a capex of almost 175 crore. And company will provide complete piping, fittings and fitting solutions. Also, they're going to use existing scrap material for this for manufacturing of fittings, which will actually that should increase their margins. They've also announced capacity expansion in value-added welded tubes, wherein expansion will be in 2 phases. In phase 1 will include fittings and welded tubes with a project cost of 115 crores. High teens margins are expected, and project is expected to complete by March 25. And phase 2 will include fittings of seamless and welded pipes. Project cost of around 60 crores. Expansion to be completed by December 25. Then we have Kaveri Seeds, which will be in focus on 325 crore buyback, which starts from today, that is Feb 29 to March 6. Company will buy back almost 44 lakh shares at 725 per share, which is at 10% premium compared to yesterday's closing price. Acceptance ratio for small shareholders will be almost 25%. Lastly, we have KSB. So they've come out with earnings wherein you saw revenue uptick of almost 15%, but EBITDA was up only 5%. If you see the margins were 13% versus almost 15% last year. Now this was due to increase in their cost of raw material. Also net profit was down almost 2%. So this is all we have today.
Okay, thanks for that, Varsha. So we'll watch out for those stocks. Stay on, gentlemen. We'll be right back, but before we take that break, and as we get into the break, some recognition for the Indian corporate business. King Charles III of Britain has bestowed the honorary knighthood on Sunil Bharti Mittal of Bharti Airtel in recognition of his efforts to strengthen business ties between the two countries. We spoke to him exclusively yesterday. Here's a small slice of that conversation.
We need first-rate networks. We need high-quality services. We need more fiber into home. We need more submarine cables. We need more satellite. A lot needs to be done. And whether it's Facebook or Instagram or it's Google search or it's all the fanciful new AI applications are all going to ride on 5G networks. And therefore, it's important that the customers recognize that this infrastructure requires investment and they should contribute happily a few more rupees per month to use this network.
Welcome back. You're watching India Market Open. Quick check on implied Nifty before we continue with trade. Gearing up for pre-open. It is expected to be a muted day, 15-point higher on implied, but a very good possibility that we might even see some selling pressure in the first half of today as we eye expiry later on in the day. Vinit, you want to comment on this Reliance Disney deal? The stock, of course, saw some pressure in trade yesterday, but they've struck a deal of sorts with, pulling down Star's valuation down from, 15-odd billion to 3 billion in the last 5 years. RIL, of course, too big to be impacted by a small deal such as this. But generally speaking, you imagine this to have an impact on the media pack, RIL, free float, freewheeling. Where do you see this impact?
So definitely, it's going to be quite impactful, especially the competition. And, we are having consolidation of two large platforms, and that is going to be very, very positive for Reliance.
Positive for Reliance, Vinit, the group company RIL is the only stock that will be impacted on back of this deal, or do you think this is an opportunity for the other group companies as well?
Definitely, TV18 should also do well.
Okay.
I think TV18 is definitely going to do well.
Okay, so TV18 and RIL, those are two stocks fundamentally to watch out for. But to you guys, to cover the SEBI story.
Let's just get in. Ashish Somaya, CEO of White Oak Capital Management. He joins us right now on the show. It's the first time that we're talking to Ashish. Ashish, thank you so much for taking the time out and being with us. Bring us in on your thoughts around this SEBI caution, talking about the small cap space, using the term froth. What kind of an impact can something like this have?
I think that Niraj, so it has been in the it has been in discussion for quite some time. You're aware that as long as as long back as early 2023, you saw that a lot of small cap funds, quite a few actually, at least 4 or 5 of them, which I can recall, including us, all of us have been running our mid cap schemes and some of the small cap schemes purely for systematic flows, which means we've been allowing only SIPs and systematic transfers and generally avoiding large money or hot money coming into the schemes. Because, typically, however much we may talk about investor behavior and investor education, the reality, unfortunately, is that, money chases returns. And you know that in the last 1 year, and as a result of the amazing last 1 year, 1 year, 3 year, 5 year, 10 year, 15 year, whatever time frame you look, small cap and mid cap seems to be the best performing part of the market by a mile. And generally, when such great performance comes in, money tends to chase. But then, it also increases the risk. Because all said and done, if you take mid cap, it is, 65% of the portfolio has to be within 150 stocks. If you take small cap, 65% of the portfolio has to be within some 250 stocks. And as you'll appreciate, everybody doesn't want to buy all the 150 or all the 250. Generally, maybe half of them are worth buying or something like that. So as a lot of money comes in, people tend to hold bigger and bigger positions. There could be impact cost. Sometimes the lack of liquidity might drive up prices, and it's like a double-edged sword.
Right.
So I think the regulator is just kind of cautioning and telling everybody to prepare for eventualities.
Yeah. Good morning, Ashish. Murli here. I have a question. See, it's always a problem when there is a non-stop bull run. We have seen the kind of inflows into small and mid-cap stocks. One of the key issues that the SEBI has raised here is it's not so much about moderating the inflows. Every fund can moderate the inflows. They can control SIPs, put a limit. That's an easier job to do. But the bigger worry is redemption. So SEBI has cautioned that there might be early movers who would get the advantage of redemption, and the late redeemers will lose money. How will the industry control this?
So Murli, I just want to tell you that, not because I want to bat for the industry, but I've been around 25 years and I'll tell you this is probably the first time where the industry itself has been proactively acting. Because let me just tell you that when you're talking about redemption, that's like saying that, okay, when the redemption comes, I need to be prepared. But gating inflows and ensuring that you get very, very granular inflows for as long as the last 1 year plus, I think that prepares you very well for eventualities. Because if you see a lot of big funds over the last 1 year at least, long-term investors would have been there for time. But over the last 1 year, 1.5 years, a lot of us would have got only granular money, right? I mean, 5,000, 10,000 per person per month kind of flow we would have got, right? So I think that gating the flows and accepting only granular money, that was also part of preparing the eventuality that ultimately someday the bull run won't sustain and there could be outflows or there could be eventualities. But coming to your point about redemption, I think, look, every fund manager, every investment committee, and I can tell you firsthand, we track the liquidity of stocks. We track every now and then when we have the investment review committees, we track how many days it will take us to liquidate 5% of the portfolio, 10% of the portfolio, how many days it will take us to sell a stock completely. All of those things are tracked.
Right. Okay, we are also joined by Dhirendra. Dhirendra is an expert who has tracked mutual funds for more than 30 years. Dhirendra, welcome to the show. Thanks for joining.
Thank you, Murli.
Dhirendra, what's your thought? It's perhaps for the first time that SEBI has kind of stepped in to very clearly say that, look, you have to put an end to this overvaluation. People keep putting more and more money into a smaller basket of funds. What are your initial thoughts on this?
My thought is that, this is really for the first time, and that is not SEBI's job. It should not be doing it. But I think it is doing out of concern. The reality of the market is a little different. When you look at, what happened in case of Franklin Templeton, then SEBI took some steps, and now we have a fallback fund of a very large scale. Just having that itself will ensure that we will not have that problem. That was the SEBI's contribution to a systemic gap that we have, that we don't have a very highly liquid market for. Likewise for the small caps. Small cap, look at the dynamics. They are getting massive flows. Investors are putting money. A reasonable part of it will be coming by way of SIP, gradual money, and long-term money, which is very desirable. And for the first time, it is happening so steadily over the past couple of years that, otherwise mutual fund inflows always used to be a very seasonal thing, whether it be 1992, 2001, 2005, 2007. This time round, it is broad-based. And look at what is the underlying. Small cap stocks, the good ones, where the promoters are running their business passionately and, fund managers like them, and they are doing they take all the things that they have all the variables which a good stock will have or a company will have. They are the companies where the foreign investors don't put money. The NPS money does not flow in. The EPFO money does not flow in. This is a market which is made up entirely of speculators on one hand and mutual fund investors on the other hand. The speculators will run away because pigs are, created to be slaughtered. And, that is what SEBI study also says, that, nearly 5%, 7% people make money. Rest of them actually are unable. So that is another segment where individual investors participate. But the fallout of that is that there is a dearth, the market falls. Some investors, mutual fund investors may also panic. And whenever there is a fall and there is no other side of the market, then the fall is very severe. And that has a significant impact. We should not forget that, in a narrow market of 2008, some of the small cap funds went down by 70-75%. And that is the fear. I don't see that kind of situation here because, most investors psychologically are extremely uncomfortable with a fall only when they see that the capital going down. Right now, most investors will be sitting on massive gains. And, investors' attitude to a decline is very different when he's losing his gains as compared to losing his capital.
Right. It's interesting because up until now we were calling all this money sticky money. Now suddenly we're concerned if there is an outflow of this. But Ashish, hi, it's Samina, and we haven't spoken for a while. But I have two very simple questions. In the last couple of years, the liquidity was a concern that SEBI talked about. But in the last few years, we've seen micro companies become small companies become mid, and mid almost become large, which means the liquidity situation in some ways has actually improved. Do you feel like there will be any actionables on this? Of course, this is the diktat, this is a talking point, and we understand that. But what happens in terms of actions going ahead? And B, if there is a little bit of rebalancing that takes place, because SIP money is sticky money, do you think the large cap space, which has been waiting for a catch-up, up, and we've been depending on FI flows for that, might actually, start doing well on back of just simple DI reallocation to the large cap space. So it's actually a win maybe for the large cap space, I'd imagine, while the warning for the broader markets.
So yes, Samina, two parts to your question. I think the first one which you mentioned, that micro caps became small cap became mid cap, to the extent that there is obviously always an underlying natural force, that to the extent that the market caps are rising because underlying earnings are rising, or the amount of investment is rising, to that extent it's fair. But if there is a general perception that a lot of this is happening only because of PE expansion, that's where I think risk assessments and the regulatory warning might be probably coming through. And it's true. Just bear me for a moment, look at the statistics. In 2023, the small cap component of the market, you look at BSE 500 as the whole market, practically small cap component was up by about 46%. But within small cap component of BSE 500, that 46%, it went up in 2023. You break it into PSU and non-PSU. PSU component of small cap went up 120%, whereas the non-PSU component of small cap underperformed the broader small cap itself. What does that tell you? It tells you that, whenever something becomes a theme, whenever something becomes a story, whenever something becomes a go-to, it's prone for risk. So I think the risk assessment is not entirely wrong. And I think that everybody needs to prepare. Now, on your second question, there is a limit to how much one can really reallocate, because if you were to say that, okay, entire small cap industry, say 1.5 to 2 lakh crores, for example, just talking top of my head, maybe 2 lakh crores, then 65% has to be in what is defined as small cap, right? And everybody cannot move all the money into large cap. So incremental money, I think investors would do well to, follow what you said. I think it's likely to happen that people might go to balance advantage funds or large cap funds or large and mid cap funds. Incremental flows, yes. But existing, maybe some managers will rebalance their portfolios, as the circular says. I don't know how much you can really put into large cap in all of these small cap funds.
Right. Absolutely interesting observation. Dhirendra, I'll come to you for a quick, short answer, the last question just before the markets open. How do you think we can stem the tide now, especially when it comes to redemption, to be fair to all the investors? What are your thoughts on that?
No, nothing can be done because, you can't really fiddle with the NAV. NAV is to be calculated the way it is. And I don't think the fear may not be, it might be a very temporary fear, if at all there is one, because mutual funds also get some, short-term money. And there's nothing which prohibits short-term money coming into small cap funds as well. But the kind of money that has flown into small cap funds over the last couple of years, and look at the returns, the long-term returns are so compelling that I have found it really the other way. On every decline in the recent past, mutual fund investors have put more money.
Thank you, Dhirendra. Thank you, Ashish, for joining us and taking us through the kind of situation that we are in as far as small cap and mid cap investments are concerned. Niraj, Samina, over to you for the markets open.
Yep, thank you. Pre-open rates have settled. This is an interesting conversation, by the way, and I think both our guests mentioned that there are some things which not too much can be done about as well, and a lot of moving parts here. Let's wait and watch. Words of caution, watch out if you're investing in the small cap space. Not all is bad, by the way. The pre-open rates have settled, and when I look at stocks which are moving around, on the gaining side, you have Shriram Finance right up there. Now, to both our guests, this will be the first question. Vinit, Bolinjkar, could it be a winner's curse, or do you reckon the fundamentals warrant continued upsides for a business like Shriram Finance?
I think the CV cycle is going through a massive upswing, and this is expected to continue. And Shriram is obviously well placed to, milk this space. They're very good in the used vehicles market, and as the vehicles get scrapped, the number of vehicles which are there on the road are more of a higher quality. Their values are much more, and hence the growth in the business can also sustain even if the numbers tend to peter out because of a falling cycle. So I believe that all these things portend very well for this stock, and this stock is only expected to move up.
look at how TV 18 and Network 18 are doing. Both are turning out to be top gainers in trades. So the markets are, reacting to that news this morning. Also, KSB on back of very weak numbers. The stock is down 5%, but we'll wait this out. Shrikant, how would you play in terms of a trading strategy? And I'm talking about the large cap names. So the two banks, HDFC, ICICI and Reliance Industries in trade this morning. If they do open flat, any directional trade there?
See, like at these levels, if we go through with the overall specific trend of the stock, then in that case, I would say ICICI Bank should be on the watch list, because Bank Nifty was down yesterday, but it was still resilient as compared to the overall performance of the Nifty. ICICI Bank was down, but it is somewhere close to its important support levels around 1,045, 1,050. From here, again, the stock can move towards the levels of 1,090 or 85. So that looks good. For Reliance Industries, I think it is very close to these support levels, but furthermore weakness is possible if there is a weakness in the market. So close to 2880, 2875, we should look for adding Reliance Industries, but at these levels, it is better to stay away. In fact, it is, in case if there is any higher opening, then close to 2950, 2960, we can see some profit taking in the market.
Okay. So that's on RIL. Just wondering, Shriram Finance, Shrikant, very quickly, do you think the upsides can continue?
Yeah, the overall long-term pattern for the stock is like really very strong. And based on its formation, I am of the view that the stock is heading for the levels of 3,000 eventually. In case if there is any correction, then certainly we should look for adding these stocks. Close to 2250, 2300 stock looks good.
All coming in on Shriram, UPL, both those counters seeing a little bit of a reaction to the rejig in trade. Vinit, apart from some of the names that we've already mentioned, is there anything that you like that has been on your radar that you've picked up? We've got about a minute or to go before market opening, but fundamentally, any stocks that you're looking to buy?
I think Sagar Cement is a very interesting play. We think that, the market in cement is going to play out quite nicely going ahead. And, Sagar Cement is one of the lowest cost producers of cement in India. And they have a lot of capacity. Their utilization are only around 55%. So there's a long way to go, and we expect this stock to do well. But, it may take a little while before the stock really starts climbing.
Okay. Vinit, is Sagar the best bet, or do you like something else as well? You're an old hand in cement, amongst other things. Is there something else in cement or only Sagar?
So, I have a bias towards this stock because, you will not lose money in this business of Sagar Cements.
Okay. So, and, okay. Yeah, please finish your point.
And hence, it's a very safe play in this segment. The other ones that we like is Adani Cements.
Okay. Okay, fair call. So there, the Ambuja ACC and the Sanghis of the world come into play. So watch out. But Sagar Cement, a safe defensive play according to Vinit Bolinjkar. Shrikant, actually we have 10 seconds. If you can just name the stock, one top stock for the morning.
Niraj, I would like to go with BHEL, Bharat Heavy Electricals, which is around 230.
Okay, so BHEL, a long call there, Sagar Cement investment there. Here's how the markets are starting off this morning. Well, flattish. So the implied open was suggesting a bit of green. We know from the pre-open rates it was not to be. So about 30 odd points on the Nifty, 0.13%. The Bank Nifty should come up on your screen next. And let's see if the banks are moving at all today. No, not really. Well, crucial to see if mid caps and small caps are correcting more than the Nifty, as was the case yesterday. No, a flattish start there too. Remember, the put-call ratio at 0.66 has declined so much. Difficult to foresee a very sharp correction, but who knows? Let's wait and watch. Shrikant will give a better perspective. We'll ask him post-open or post-marking these stocks. Bring up the Nifty movers and see what's moving and what's not. On the index per se, on the losing side, because there are a lot of losers, by the way, Bajaj Auto nearly 3% lower. Now, I don't know if there was a news flow here, but certainly started off lower. What else? IT is really under pressure today. So HCL, Techem, TCS, LTI, Infi, all 5 in the top 10 losers list. So excuse me, watch out for IT as well. Some corrections in Cipla, so that's to be kept in mind, but no big shakes. It's IT To an extent, Bajaj Auto, which stand out as the top losers on the gaining side, and the market is just making a bit of a turn. The number of greens are improving a little bit. Reliance is the top draw, 1% higher. There is Coal India, Eicher Motors, Bharti Airtel about 1/3%, but nothing too dramatic. So, I mean, the gains are a bit subdued. The losses too, nothing too dramatic. I would say, Samina, with Reliance being the lone ranger of sorts on the gaining side, and IT being the key losing pack on the session, but a fairly muted start on the index.
Yeah, on expected lines. You can't expect it to see fireworks, especially after the fall we saw yesterday. And I think this market is lacking cues and triggers, right? So that's probably why you're seeing a muted start on day of expiry. A quick check on what's moving. Like Niraj said, it was RIL in the large cap space, but beyond Reliance Industries, the other two that are reacting to the RIL Disney deal is Network 18, Sun TV and Z. Network 18, no runaway gains there, which is what you'd have usually seen on a good market day. This morning, because the sentiment's muted, the reaction is about 2%. Not to say that you may not see further gains roll in as we go along through the day. Z is trading flat. Sun TV also trades flat. Z is out of the F&O ban. But of course, because of the media space, those are the counters that will see a sentimental impact for now. So Sun TV and Z, if you can pull up Dish TV as well, that would be useful. We'll get a sense of what that one's getting up to in trade this morning. Well, apart from that, Nifty changes. So UPL is leading the losses, like Niraj indicated, in the Nifty 50. You've got Shriram Finance actually gaining 2.5% up move on being introduced on the Nifty 50. So that is a big move coming in there. You've got KSP. They reported weak set of numbers. Their revenues were higher, but largely speaking, the numbers were weak. The stock is taking to the chin. It's down 5%. Another one to mention is Brightcom Group. Now, SEBI has actually investigated this company on back of a preferential issue of warrants that was done, but only partial payment was done for the allotment, and because of which they're coming under the scanner. The stock is down 4%. So KSB and Brightcom are the two big losers. Smaller companies, but definitely worth a mention. But other than that, you've also had MOSL that has actually gone and had given a target price increase of 22% on JSW Energy. The stock not reacting to that just yet because the largest sentiment on the street is fairly muted, Niraj.
Oh, yes, indeed, Samina, and that kind of sums up what's happened in the markets. So therefore, definitely something to monitor today. Let's just bring up, before we get to our guests, there is a chart which shows the top gainers and losers on the Nifty 500 or the NSE 500 or the BSE 500 as the case may be. If you can just bring that up, just gives a sense of what are the key movers across the mid caps, across the broader end of the spectrum. So this is it. And if you could just look at that list, clearly shows, if I'm not wrong, Sobha is amongst the top gainers on the BSE 500, 361 is one. Brigade is up 3% as well. So clearly, real estate is having a good day, and TV18 is down 5%. Just bring that stock up, TV18 and maybe even Network 18 individually, just before we get to our guests. Can we just pull up the individual charts of TV18 and Network 18 down in the session today? Bajaj Auto, by the way, ex-eligibility because the buyback date was yesterday, so I think that's probably the reason. But opening thoughts, before I get to Vinit Bolinjkar on the falls that we're seeing in TV18 and Network 18, Shrikant, Chouhan, just one quick word from you. While you gave the index verdict, just wondering if you believe the Bank Nifty can have some substantial downsides, or will it kind of take support at the current levels?
No, I think for the Bank Nifty, if we see the stock-specific action of each and every stock, then most of the stocks are very close to their important support levels. Like HDFC Bank is very close to the 1400 levels. ICICI Bank is around 1050. So broadly, we are of the view that the pace that we are seeing, the pace of sell-off that we are seeing in the Nifty, I think the similar sort of pace we will see in Bank Nifty. I'm of the view that, on which just now you discussed that put call ratio, which is like around 0.66, 0.75, 0.60. I think it's a completely oversold territory for the market on the day of the monthly expiry of the market, of the Nifty. So broadly, we are of the view that in case if we see furthermore decline during the day, close to 21,800, the reason is because 21,875 was the previous lowest level. And if we see the market is breaking to that, then we can see some technical sell-off in the market at the in the initial part of the opening. But I think later on 21,800 should act as major support for the market. There we should look for taking contra positions. I think the market is going to reverse, or maybe it will close in the positive territory towards the end. That's the overall view. And for the Bank Nifty, I don't think that it is going to fall furthermore. But yes, 45,300, 45,400 are the levels where I think the Bank Nifty can fall.
If you've got to play the sectors or the themes that the markets have been playing, which is largely defense and railway, so anything government focused. Now, most of the companies that are government focused are from the broader market. So your defense, your rail. Now, these stocks are seeing no recovery this morning despite a big fall yesterday. Would you opportunistically buy into the space this morning, or would you avoid it till the dust settles with regard to the SEBI's advisory or warning for the broader markets?
It's for me.
Vinit, it's for you. Vinit.
Yeah. So I think that we've seen some very elliptical moves come in the market, actually parabolic, and we are correcting that. So while we are quite constructive on the space, we like this space, they have got very, very strong trends playing out. I think that, as I mentioned to you earlier in the chat, that we expect the markets to be down. So I think this exuberance is kind of being sold into, and it will be a while before we would be looking to buy these stocks. So I think they are going to be down for a bit. And I would not like to catch a falling knife, at least in a time-wise correction where I think that the last week of March is when one should be doing the shopping for the next 1 year.
Okay, Vinit, any reasons for the disappointments for Network 18, TV 18? They're both down in trade today.
I think the sentiment of the sell-off is overplaying with everyone, and I think it's been sold into the news play.
Fine, but so therefore, are you a buyer here, or is it something within the deal contours that is disappointed? Because I remember earlier last week the Reuters story spoke about how it will be done 61% through Viacom 18. Is that the factor behind this as well? Because it's no longer 61% but 46%. So in that sense, the relative.
So I think I will be buying this, as I said, at the end of the month. The story is definitely in favor of the group. They're all going to do well. And it's only about timing it. I think the timing around end of March is what I will be looking to buy.
Right. You've got All Cargo surprisingly doing quite well. They, of course, talked about how their monthly numbers were impacted because of Red Sea and the stock saw pressure. But I'm not sure what's happening. Do you know what's happening on All Cargo, Niraj? 5% up move. Volumes are also actually looking pretty good on this one. We'll wait and see what's happening. Vodafone Idea is seeing a little bit of a recovery after yesterday's fall, up about 2%. You want to check on other counters. So Brigade, like Niraj said, is having a good day. Ujjivan Small is doing well. Shrikant, do you want to come in on All Cargo and Vodafone on the long side? Do you think fresh longs can be initiated at these levels? Both those counters are gaining on pretty healthy volumes.
I think for All Cargo, the view is very clear that it is consolidating within the range of 88, 89 on the high side and 72, 75 on the downside. So the way there is expansion in the volume and price pattern, sorry, I think at these levels it's a buy. It is heading for the levels of 98, 99. The overall news flow is also supporting to the same. From the Idea or Indus Tower, I would like to go with Indus Tower, which is around 242, 243 levels.
Indus Tower is, in fact, that was Shrikant's pick as well. The stock is slightly lower this morning, down about 1% odd. JSW Energy as well is seeing a 2% cut. Punjab Sind Bank on their fundraising plans. If we can pull that one up too, it would be useful to see trading flat. IRCTC, IRFC, all those real estate names are seeing a little bit of pressure. Inox Green is also seeing a cut of 3%, and so is Inox Wind. Well, that's pretty much the market flavor. It doesn't look like it's going to do too much. At least the selling, Niraj, I'd imagine, has been arrested. And we're not extending the selling. Of course, the buying is still not coming in, but it's anybody's guess if we end the Feb series about 22,000 today.
Yeah, very. On that sums it up really. Just one marking of Bank of Baroda and whether that stock has had any move on the back of what Citi's note says, wherein they have a buy on BOB. But no, not really. Very quiet. Gentlemen, Vinit Bolinjkar as well as Shrikant Chouhan, thank you so much for taking the time out and being with us on the show today. Really appreciate your time. Well, on that note, we need to slip into a quick break. But up next, two very special conversations. We first have Charles Gav. He's the founder of Gavekal Research, and he speaks about how or why global fund houses might be interested in making a larger allocation to India in a disrupted world. Stay tuned. Charles Gav has the oldest or the most amount of experience into the field of research. He spoke on multiple things, including his view that India's current account moved into deficit because energy imports went through the roof, but that situation will change. In our special series Worldview, he makes a case for bonds into India, into China, and equities in India. Listen in.
Every time you were growing a little too fast, your current account moved into deficit, and you had to slow down the economy, raise rates, and basically it was a stop and go system. Now, if suddenly your current account went into deficit because energy imports went through the roof and you had to pay them in dollars. So now if you can pay your current account deficit with your own currency, then suddenly you don't have to look at the current account deficit of India, including energy. You just have to look at the current account of India, excluding energy. And there you have, first, pretty large foreign exchange reserves, and second, you're in equilibrium or in surplus. So what I mean is that suddenly you have to look to know when the Indian government is going to tighten. You have to look at the current account X energy, and if it moves, as long as it is positive, and as long as inflation is subdued in India, you have no problem. And for inflation to be subdued in India, the easiest thing to do is to allow a constant, small revaluation of the rupee against most currencies. Like that, you will have a very subdued inflation. So I have spoken previously about the US being a deflationary boom. If you have no massive monetary policy mistake made in India in the next year or two, India should enjoy a massive deflationary boom for quite a while. Your interest rates are still fairly high. They're at 7 now. So they could go easily to 5 or 4 over the long term, especially if foreigners are buying to build up position in a country which has one of the few good demographics in the world.
That's true. Tell me, Charles, money flows into markets like India, not as much in an idiosyncratic fashion as much as it is a part of an emerging market pocket, if you will. And emerging markets per se, by virtue of what China is going through or some other economies are going through, are not quite giving returns. So how attractive could, albeit a large market, but how attractive could a market like India be to foreign capital, which is looking at emerging markets as a bucket, even though India may be having these demographics and these growth numbers?
Okay, let me put it this way. The way I look at India and China is pretty simple. China doesn't need foreign capital. They are an excess saving nation and always have been. So I seldom buy equity in China, except when they are dirt cheap as they are now. Okay? Because they don't need my money. India is almost always a nation that doesn't have enough savings, probably also because you are very young. Makes sense. So it's always a good idea to invest in countries that have a deficit of savings in the equity market, because they will make it, the market will be attractive for you to send your capital to India. So my inclination on a structural basis would be in bonds in India, in China, and in equities in India. But the problem is that the equities in India are a little bit expensive today.
Always been, yeah.
And the bonds the equities in China are very cheap. And the reverse is true for the bond market. The bond market in China is a bit expensive. And the bond market in India is a bit cheap. So cyclically, I would probably recommend to build a portfolio that would be Indian bonds and Chinese equity. But that would be out of a portfolio that for the last few years would have been Indian equities and Chinese bonds. So I'm just trying to rebalance a little bit the portfolio here. But what I'm saying is that India will need capital for the next 10 years so easily just to build their infrastructure. And they will have to make that attractive for foreigners. And why not buy equities there structurally? You see, the Indian market is expensive, okay, but the profits are growing very strongly. So if you do the P ratio of one's growth rate, India is kind of kind of okay.
Yeah, true. My final question, Charles, can Indian growth sustain for the better part of the next few years at a point of time when the world growth is looking so uncertain? China, Europe, you mentioned about the US, high inflation possibility and higher rates possibility, so lower growth maybe.
The beauty of India, to a large extent, that it never paid any attention to the rest of the world. You have been always self-centered. As a percent of GDP, your export and imports are minimal. They're very slow. You have so much potential in India just by organizing your infrastructure, your roads. And probably the biggest effort in India will have to be made for things like nuclear energy. So you have to find a way to finance the development of your infrastructure. And that will take at least 10 to 15 years. In China, it took more than 20. So what happened in the rest of the world should have very little impact on the Indian economy. My belief is that the Indian economy is now in the hands of the Indians. And if they do correctly their long-term views, organizing a bond market, monetizing the savings in India and so on, to invest in infrastructure, what happened in the rest of the world will have no impact on the economy, but it may have a temporary impact on the stock market. If, let's say you take a beating, I don't know, in Wall Street or what have you. Well, if you take a beating in Wall Street, I suspect the Indian stock market will go down in sympathy.
Right.
But nothing to do with India.
In what is a great honor and recognition of the prowess of Indian business, Sunil Bharti Mittal, founder and chairman of Bharti Enterprises, has become the first Indian citizen to be conferred an honorary knighthood by Britain's monarch King Charles III for services to India-UK business relations. Now, this recognition is one of the highest honors given by a British monarch and underlines the growing might of Indian business and, of course, our corporate leaders. Now, in this mega exclusive, I'm joined straight from London by Mr. Sunil Bharti Mittal to talk about how important this is. Of course, the honor for him, for Indian business and for trade relations between India and the UK. Many, many congratulations, Mr. Mittal, or should I now refer to you as Sunil Bharti Mittal KBE, because that's what the honor means.
Thank you very much. Thank you. I'm truly delighted and, of course, humbled at this great honor bestowed by the British government, His Majesty the King, on an Indian who has been working for the last several years to strengthen the relationship between our two countries.
Yeah. You have been, doing business in the UK for a long time. You're part of the India-UK CEOs Forum as well. You have a listed entity there since 2019. And of course, you've helped revive OneWeb in a consortium with the UK government. Now, why UK? And how have they made it easier to do business? What does this mean as significance for the scale and prowess of India's business?
Well, UK has always been a natural choice for Indian businesses to set up businesses here. If you may go back in time, Tata's bought into the steel business here. The tea, Tetley Tea was bought over by Tata Tea. And of course, the Jaguar Land Rover, which is much celebrated here in the UK. And then we have had other business houses who have come in here from time to time. It's a place where many people have their offices. They regularly come here. And so it is only natural that we looked at UK for business opportunities. And I must say that the welcome from the British government, the authorities, has been delightful. I think it's pretty easy to set up business here in the UK. And talent is available in abundance. And those who regularly come in and out of UK can vouch for it. There's a good place to do business. In particular, I must say, in the last 5, 7, 8 years, India's position in UK has really gone up. Indian businesses are particularly cherished here. They are seen as good corporate citizens, people who are getting more and more employment here locally, bringing technology from India, of course, besides the money that they come and invest here. So I think this is an award which recognizes India's rise in the global stakes in the business arena, and importantly, recognizes that those who work for India and UK's stepped up relationship need to be awarded.
Would this be the right way to also look at it, Mr. Mittal? And, our viewers would be very interested in this angle, that when businesses need to be rescued, then Indian business leaders step up. And we've seen that time and again with UK businesses. We provide jobs there, we provide employment, and we save some of their businesses, like we saw with OneWeb.
No, it's true. I mean, we saw that in GLR, we saw that in the steel, the Tata Chorus. We saw that in the refinery in Stanmore, which Ruiyas have set up and taken over. So yes, there are lots of good cases. I think Indians move fast. They are entrepreneurial in their very nature, unlike many European or American conglomerates who will take a lot of time. And some of these businesses need very quick and fast decisions. OneWeb, for example, was requiring a decision within days. A bid had to be assembled. Somebody had to lead the charge. The British government invited me right in the middle of the pandemic, and the bid was made during that time, and successfully the company was taken out of Chapter 11. A full satellite constellation of 640 satellites has been set up with a lot of investment and efforts right here from the UK, covering the entire globe. This is, to my mind, one of the sterling examples of India-UK cooperation.
Yeah. We have a wide audience this evening, Mr. Mittal, watching you across our channels on the network, which is why I'm going to request you to explain to us the significance of a OneWeb, especially in the context of a Starlink, which is the big behemoth. Why is this such a big deal and at the cutting edge of communications and space technology today?
Well, as you know, space is now getting a lot of focus and attention from all major global players. Thankfully, India is one of the major space actors in the world. In fact, when I was invited to the Downing Street to take OneWeb out of Chapter 11, the then Prime Minister Boris Johnson made a remark that India is truly a first-rate space nation. And, we do our own launches. India manufactures its own satellites. We are now planning to send astronauts to the moon. I mean, so much is happening. I heard our Honorable Prime Minister talk about India having its own space station by 2032. And what we did with the lunar landing just a few months back was a historic achievement and the lowest cost by any nation in the world. So India has something very special. And I think OneWeb, from that point of view, is an India-led British partnered consortium, which, by the way, also has now the French government as a participant. It covers the entire globe. My industry, mobile industry, has not been able to cover the last 2.5 billion people on the internet. There are lots of dark areas, deserts, mountains, forests, oceans, in the skies. There are lots of places where you don't get connectivity. And what a Leo constellation does is precisely that. You can raise your hand anywhere in the world and you can be connected. It is the power of a Leo constellation. Starlink is a formidable competitor. In fact, they have a lead. They are ahead in the race. They have put in many more satellites and they have a large market presence already. Our model is very different from theirs. We are serving the governments, the defense forces, the industrial applications for mining and warehouses and manufacturing units in remote areas. We serve the maritime industry, the aviation industry, oil rigs, etc. So we will have our own business model where we will go and provide broadband connectivity, something that I have worked on for, I think, now over 2.5 decades. Yes. Telecom, as you know, has been my area of interest, and this just expands the area of broadband connectivity, especially of those people who have been left behind of not getting internet.
Absolutely. It's all about connectivity. Just to, points to understand, Mr. Mittal, how many jobs did you save when you rescued OneWeb from Chapter 11? And
well, I would say,
how much did you save the UK government? Yes, sir.
Hundreds of jobs are saved. OneWeb has its headquarters here in London, and obviously this company would have gone down if a rescue package would not have been put together. Yeah. We raised about $2.85 billion, in which British government also put in $500 million. We got the French investment, we got the Korean investment, we got the Japanese investment, and of course the India's investment was the largest, and Bharti being the single largest shareholder.
Yeah. Now you've explained how OneWeb can really connect the world. I want to understand the Indian context because the regulations have come in. As I understand it now, we're awaiting allocation of spectrum from the DOT. What kind of timeline can we look at for a rollout of OneWeb, and how would that change lives here?
Well, I think for India, this is really very special. India took the bold decision of not falling into the trap of getting into spectrum debates where they should be auctioned or given administratively. This is a shared spectrum, as we all know. It's going to be used by any and everyone. Whoever wants to use the same spectrum is used. There is no specific, proprietary assignment of spectrum, unlike mobile phones. So that decision is done. The second part was FDI. India has allowed up to 74% automatic FDI for SATCOM. Our ground station is ready in Mehsana in Gujarat. We are just now awaiting allocation of spectrum to start our work. I hope the government can take the next step of assigning the spectrum so that services can be launched at the fastest possible time frame, especially start serving the remote areas up in the upper regions of Himalayas, deep in the Rajasthan deserts and many other places.
So apart from increasing connectivity in remote areas, would this also make it cheaper and more accessible to the average Indian?
The satellite phones are generally considered to be expensive, but thankfully with the Leo constellation, the pricing has really come down dramatically. You will have community Wi-Fi, you drop in a terminal in a village, and you can have, let's say, 50, 100 dwellings connected to it, so thereby making the price become even more affordable. Yeah. We will be fairly close to the terrestrial pricing. Of course, satellite will always have a premium. We are also talking to the government how USO funds can be directed towards these rural efforts of the SATCOM providers.
Yeah, it could totally be a game changer. So I just wanted your thoughts on the UK-India partnership because, in a sense, of course, this is an honor today for you and your contributions, no taking away from that. But it also cements the India-UK trade partnership. And the next big milestone that everyone's waiting for is the FTA. I wanted to know your thoughts on that. What is the hurdle for the free trade agreement? Do you think that those could be ironed out soon, especially in a year which is an election year on both sides?
Well, FTA discussions are always tough, at times contentious. But I think from what I have been watching from close quarters, a lot of progress has been made. Both sides have had to give in. Both sides had to stick to some of the very important areas they wanted to preserve. And I think we are very close to an FTA, but it's never done until it's done. I must compliment Minister Piyush Goyal and his entire team who have been negotiating with the British counterparts, and equally to the team here led by Minister Kemi Bedendorf, who's Mr. Goyal's counterpart, and her team, negotiating team. I've been meeting them regularly. I've met the British teams a few times. I've met the Indian side several times. And I must say there's tremendous amount of goodwill now. And I know Honorable Prime Minister would like to see this happen. There will be now political compulsions which will delay the process. Indian elections are around the corner. Then the British elections are later in the year sometime. Will there be a window post May, or between May and June, July, when something can be done? Let's see. From my corner, I will try whatever I can to ensure that the Indian industry gets the best benefit from this FTA, and equally is fair to both sides.
Yeah, we were talking about it maybe last Diwali. Who knows? Perhaps by this Diwali it could be inked. When you say it should be a win-win, and especially for Indian business, what would be the biggest plus from the Indian perspective of an FTA?
I think one of the issues that have been stuck for a while is the issue of Indians who work here on a temporary basis. They contribute towards the social security packages, whether it's NHS or it is the pension schemes. And when they go back, that money is lost. And they don't end up using any of those services here in the UK because they've gone back for good. And that's one negotiation which I know has been going on. This is always a difficult issue to resolve. Other issues have been around certificate of origin or rules of origin, which have also made a tremendous amount of progress. UK's need has always been on Scotch whisky, on electrical vehicles, on biotechnology, and India's need has been on free movement of people and getting the right amount of access to the British market. So, as I said, there were chapters and chapters which had to be negotiated. A lot has been achieved, and a few issues are remaining. I really hope that we come out with a very strong outcome of this FTA. One thing we must make a note of is that India today is in a very different position than it was several years back, when it did some FTAs with Southeast Asian nations and some other counterparties. Today, India is very strong. It's a market of 1.5 billion hungry, consuming people who want to use more products and services. It's a market that the British industry cannot miss. It's a must-have market. So I would say India will need to be getting very attractive terms for it to be signing on this FTA.
Well, that's a superb takeaway. Maybe we're in the best bargaining position or negotiation position than we've been for the longest time. You've given me a lot of time, Mr. Mittal. I want to thank you for that. But before I let you go, I just want to get your take on, where you see the Indian telecom sector heading. It's grown by leaps and bounds. It's faced its challenges. It's connected this country like never before. A lot of developments recently, and the question about, whether these businesses now can thrive, whether customers are paying what they should. I just wanted to get your sense on an outlook for the Indian telecom industry.
Well, I have mentioned this many times before. Telecom is a very, very capital-intensive industry. My company alone has spent 40,000 crores on 5G spectrum and an equal amount on rolling out the network, and still more needs to be done. One of our competitors has spent 80,000 crores on spectrum and about 60,000 crores on the network. So this is a serious investment business, and it's a serious infrastructure that carries India's real flow of economy. Be that UPI, be that Aadhaar, be that all the financial services, health services, government services. This is truly now a remarkable infrastructure that has been built in India. And the problem here is that it doesn't stop. You don't build a refinery or a steel plant or a fertilizer plant and then stop. You just need to continuously invest, innovate, invent, and that takes billions of dollars, tens of thousands of crores of rupees. Tariffs, therefore, needs to be suitable to give rewards back to the shareholders. There should be a decent return on capital, and that, to my mind, has been woefully short of what is the right level of returns. I have always said we need to get to 300 rupees ARPU. We are at 200 rupees now, still some way to go. And when I said 300, the cost inputs were much lower after 7 or 8 years of inflation and the rupee depreciation against dollar. That 300 rupees also looks less now, but at least let's get to 300 rupees. And to my mind, that will still be the lowest tariff anywhere in the world. We need first-rate networks. We need high-quality services. We need more fiber into home. We need more submarine cables. We need more satellite. A lot needs to be done. And whether it's Facebook or Instagram or it's Google search or it's all the fanciful new AI applications are all going to ride on 5G networks. And therefore, it's important that the customers recognize that this infrastructure requires investment and they should contribute happily a few more rupees per month to use this network.
Absolutely. Do you see that happening anytime soon, given the current conditions?
Well, I think so. I mean, all of us need it. At some point in time, this should happen. Now, when will that happen is always hard to say. We are always willing to take the lead. We have taken lead in some of the packs. And as the market gives us a signal that we can probably do a little bit more, we will do so and not shy away, because in the end, balance sheets need to be healthy. India's digital dream rides on these few networks, and they need to be robust.
Undoubtedly, undoubtedly. Thank you so much for speaking with us exclusively, Mr. Mittal. Many, many congratulations once again. Today, of course, this is an honor for you, but all of Indian business as well. Thank you.
Thank you very much.
Thanks for tuning in to this broadcast and of Talking Point. And I think we have a new kid on the block getting listed today as well. Here's the ringing of the gong. GPT Healthcare, remember, got subscribed about 8 times or thereabouts. And let's get the stock price up on the screen if we can, please, and just see what it is doing. 15% higher on open. So much unlike Juniper Hotels yesterday, which had a subdued listing, GPT starts off on a good footing for now, about 18% higher on a subdued day for the markets as well. So not a bad start. Let's see if it sustains this. Remember, like I said, you can't compare a hotel and a healthcare stock, and the subscription numbers anyways were different. So suffice to say, worked out this way. Okay. Now, thanks for tuning into Talking Point. I'm Niraj Shah, and our case for a chat today really focuses or centers in a big way around the retail participation in equities and whether that is set to rise, very likely so. But could the SEBI caution around SMIDs result in some bit of extended heat for some of the small and mid-cap stocks? That is a key thing to monitor as well. The other question that we ask is, for the markets to do well, it is natural that the heaviest weightage index, which is banks, have to do well. Could 2024 finally be the year of banks, because 2023 was anything but that? To talk about all of this and more, and talk about some of the key news flow today, we have with us Nimesh Chandan. He's Chief Investment Officer at Bajaj Finserv. Nimesh, good having you. Thanks for taking the time out. I hope all is well.
All good, Niraj. Always a pleasure to be in conversation with you.
Thank you. Likewise, Nimesh. Just the cautionary tone sounded off by SEBI. It's not the first time that experts have spoken about it, just that when SEBI comes in, when SEBI uses the term froth, it makes people stand up and take notice. I'm wondering, when you're thinking about this space, are you concerned per se with the overall valuations? Or it may not matter as much because, yes, the overall valuations may stay elevated, but there will always be pockets wherein smart investors can find good growth stories.
I think, Niraj, for the couple of months now, or maybe a little more, fund managers, CIOs have been coming on television and talking about that when a certain category gets into very high expectations and overvaluations, you need to be a little cautious when you are picking companies or themes from that side of the market. And small caps also have been in discussion in that same lens, that they have rallied significantly in the last year. And now when you're looking at businesses in this space and investing in this space, you have to be a little extra cautious considering the overall valuations. Not that you would not invest in a small cap. So, for example, at Bajaj Finserv AMC, when a good business comes as an idea for us, we don't immediately cut it off because it's a small cap. But obviously, we look at a little more cautiously as to what valuations the company had and what is it trading at today, what kind of expectations have already been built in by the crowd. And ultimately, investment is about understanding the difference between what you think is the intrinsic value of a company and what market is or market prices have already built in terms of expectations. So a lot of experts have been talking about it, and I think SEBI also wants to just hint to people that just be cautious here. It's not that there are no good businesses in small caps or not companies worth investing, but just that you have to be cautious about liquidity, volatility in this segment. I think that's the main message.
Yeah, most certainly. But I'm still trying to get to this idea, Nimesh. A clutch of sectors, a clutch of newer avenues that have opened up in India. I mean, the PLI beneficiaries, sectors like chemicals, etc., just don't have a large cap presence, maybe one or two. But some of the high growth companies, potentially longer gestation companies of growth, are currently mid caps or small caps. Because, I mean, by definition, small caps and mid caps, the average market cap has also gone up, right? So, or by performance. So, my limited point is, yes, it's good to be cautionary in this space because the stocks have gone through the roof in multiple areas, but it still remains possibly the best hunting ground for longer term growth stories, doesn't it?
Oh, you are absolutely right, Niraj, on that. There are, as I said, there are very good businesses here to really pick from. And overall, we are in a very beautiful situation in the country where our macros are doing very well, much better than I have seen in my career compared to some of our peer countries where we were generally compared to. We are doing much better in macros. Our corporate earnings growth is extremely good. It's doing very well. It's well diversified. So the earnings pool that contribute to the growth in the overall Nifty or in other indices, that pool is very well diversified. So India is a beautiful market for stock pickers to really build a good portfolio. And we are bullish over a longer term about all the categories, large, mid, or small. There is wealth to be created. But often what happens is when markets get excited, they discount multiple years of growth in a particular business or in a particular category or say a theme, and they give the value for it today. So what happens is, even if those growth prospects, the potential translates into reality, if we have already factored that in our current estimates and in the current price, then the price doesn't see that change. And life is lived in cycles, but people like to project it in an Excel sheet in a straight line. Whenever there is even a small downturn in those areas where people have high expectations, then the stocks collapse very quickly. See, the intrinsic value or fundamental value, however vague concept it is, it acts as a magnet to the price. Many a times people move ahead of pricing some opportunity very high very soon, then it has to correct. Sometimes people get depressed, like some of the areas you mentioned in PLI. For example, look at the chemical sector. Last 3 years, it's been a big underperformer. So now, when the businesses actually they come up from this slowdown or downturn that they have gone in, you'll see the re-rating also coming in when the numbers come back. On a longer term basis, ultimately stock price follow the earnings growth or the profit growth in a company and the sector.
Okay. Nimesh, 2023, okay, firstly, are you constructive on markets currently, or would you believe that tactically, if you were to play tactically, if your mandate allowed you to play tactically, would you sit on a larger pool of cash?
I'll do better than that for you, Niraj. So we actually split our, so we launched a Balance Advantage Fund which uses fundamental and behavioral indicators. So I just split the view from there. On a fundamental basis, and this is the large cap view, on the fundamental basis, we are at the intrinsic value, very close to the intrinsic value of the Nifty. That we calculate a number of parameters and we come to this. And we've done some back testing, and this intrinsic value we calculate has historically been like a regression line around the Nifty. So we are okay with that. This is the steady state of the pendulum, that this is the intrinsic value. Now, market doesn't stay at intrinsic value. It moves around that intrinsic value based on the sentiment or behavior or the expectations from the participation bias of the crowd. Now, there is a behavioral indicator we've created which tells us that. So now that indicator is still bullish. We look at 4 different markets, 16 different parameters to look at it. But that indicator is still bullish right now. So markets are at fair value, but can trend higher in the near term. So as you said, tactically, they can trend higher because of the bullish sentiment. There is no letdown in terms of that.
Got it. Okay. Okay. Point well taken. Now, just wondering for 2023, Nimesh, one can argue that among sectors which did well, banks as a fundamental performance didn't have a bad year. Maybe because of supply or whatever, the larger poster boys have consistently seen a pullback, whereas maybe there are some idiosyncratic mid-size, small-size banks which have done okay. My larger question is, do you envisage a situation wherein 2024 could be a year wherein banks could maybe do well despite maybe potential NIM compression, but because supply-side issues ease, maybe the stocks may do well relative to what they did in 2023?
Okay. Let me first come to the market perspective and then outlook from our side, especially on the banking sector.
Sure.
There are 2 things that impact the stock price movement in the near term. So typically you will see the crowd always looks forward, right? We don't look at historical numbers and then look at the stock prices moving. The market looks forward as to what is expected in the future and then tries to discount that into the prices. The second part or characteristics of the crowd is that when we are in a bull market, when markets are moving up rapidly, people they reduce their investment horizon, they shorten their investment horizon. So they look at very near-term data, month or a quarter, that way. Now, if you combine these 2 characteristics, people are looking forward, but they are looking at very short-term. Any sector or stocks where you see there is a near-term trouble, people don't want to invest in it. People try to ignore it, saying, okay, I would make quicker money somewhere else, and they start moving there. And that leads to these valuations getting depressed in companies that have shown some historical good numbers, but are looking at some short-term issues, maybe a quarter or two in the future. I think that's what's happened with the banking sector. We look at banking sector now coming to a fundamental view on three different aspects. You look at asset quality, you look at their net interest margins, and you look at the credit. Their asset quality is good across banking sector. We, I think, are swimming in the best of times in terms of asset quality. In terms of net interest margin, there is some pressure expected as deposit rates start going up. So there could be some near-term pressure in the margins of some of the banks. And the third is credit growth. I think if India is doing capex and consumption is expected to do well in India, even credit growth will be healthy. I don't think it, maybe again for the near term, between net interest margins and credit growth, some companies may choose margins more than growth. So that can lead to some changes in numbers in the near term. I think this is the reason why banking sector, despite giving good numbers last year, has in the near term underperformed, and especially some of the private banks, because they are seeing a little more pressure on that in terms of deposit growth. But these are short-term issues. In the longer term, the banking sector is extremely big, large part of the economy, very important for various indices and for businesses. So I think for a long-term investor who can look beyond these short-term issues and take opportunity of picking up some of these companies at good valuations.
Got it. Okay. Nimesh, stay on. So much more to talk about. We need to slip into a quick break. On the other side of the break, we try and talk about some of the key newsmakers of the day today and get in Nimesh Chandan's view on the same. Back with Talking Point right here on NDTV Profit. We are in conversation with Nimesh Chandan of Bajaj Finserv. Now, before we get back to his conversation, let's talk about a big merger story from Dalal Street. Reliance and Disney signed a binding agreement to form a 70,000 crore joint venture. Reliance has started off on a positive note, but the other allied entities haven't. And maybe this entity impacts some of the other media businesses in the country too. Smriti Chaudhary Johnson to tell us more about the details of the merger and its implications. Smriti?
Good morning. Yes, you mentioned about the valuation. That's the whole valuation of about 70,000 crore rupees. But let's kind of break it down a little bit and look at the individual valuations. If you look at the valuation of Reliance Media business as a whole, it comes out to be around 40,300 crore based on the stake in the entity. But if you look at the investments they have made in their media business, that's close to about 40,100 crore. So not a lot of value accretion that's happening for RIL from the looks of it. If you look at Star India business, that's valued up at about $3.14 billion. This is a sharp decline from its valuation from pre-COVID levels that was pegged at around $14 to $15 billion. That's according to Elara Securities. So a sharp valuation decrease for Star India business as well. However, for Star India, this ends a long struggle that Disney has been facing in India. They've been losing subscribers after they lost IPL rights to Viacom 18, and this is the digital rights that they lost. But there's a lot of synergies that are kind of coming together for this joint venture. If you look at the total number of channels, they'll have more than 120 channels and 2 OTT platforms. They'll have access to over 750 million viewers in India itself. They will also have a monopoly in cricket, and this is in a country which is a cricket-loving country. Viacom 18 owns digital rights of IPL. Disney owns television rights for IPL. But both of them are struggling to monetize these rights. Just to give you a little value of how much these rights are worth. They bought these rights at a combined value of $6.5 billion. Now, Disney also owns ICC rights from 2024 to 2027. The merger, however, is set to improve the income for Disney's sports segment that they've been struggling with in India for a while. This will also limit the volatility of net additions, net viewers for Disney as well. Now, overall, the earnings contribution for RIL from the merger remains small in single digits. This is according to Morgan Stanley. But it provides a pathway for RIL to kind of leverage on their digital platform and improve returns and monetizations.
Smriti, thanks for putting that into perspective. Nimesh, come in on this one. It's a space that has largely not created wealth for a number of years now. Is the space consolidating? Is that good for broadcasters? Or does something like this, a behemoth getting created, create issues for some of the others, particularly in the GEC space?
Without commenting on a specific company,
agree completely.
I would say the consolidation is the way forward here, actually, and this is where we had so many companies coming out with OTT platforms, and I'm sure, many have certain pockets of niches where they are very strong. Obviously, the merger that you were talking about is two mega, large platforms coming together, and it will definitely have impact on the other players in the industry, and quite significant.
Okay. Sorry, just trying to understand this better. So, if at all, would you be constructive on media at large, or would something like this kind of make you stand up and say, let's see how things play out, we can take a call later on?
So, we have very little exposure to media space. We have it through conglomerate only. We don't have a direct exposure much in the media space. We have better opportunities or growth stories right now in the other sectors. And this sector we'll watch for some time before taking a decision.
Fair call. So where are these opportunities now? What are the first amongst equals, Nimesh, to your mind?
So, Niraj, anything that is right now visible on the table, where you can calculate earnings and come to a PE ratio, everything seems to be now fairly valued or discovered. And you can play a compounding story from here in some of these companies. But if you really want to pick up really high compounders or high growth now in, say, wealth creation, one has to look at the market with a contrarian streak a little bit, or look at companies which are going through some short-term trouble, businesses which are going through some short-term downturn, and where the crowd has either overreacted to a negative that has come, or not reacted to some turnaround or positives that are happening. And so if you go fishing right now, where you may find more fishes and less water, so your chances of a hit rate are better, are those companies or sectors which have underperformed for the last 3 years or 4 years, and find there. I find a lot of companies which used to be among the companies called quality at any price in somewhere in 2018 or so, and now for last 5 years, 6 years, they have not performed. Their earnings have grown, their intrinsic values have gone up, but these companies, the stock prices have not, because they've not been exciting stocks to be there or exciting themes to be there. Several of them are in the consumption space where one can find very good opportunities to pick up some of these companies across market cap categories. And private banks we spoke about is one such category also.
Private banks is one such. You mentioned consumption. I was almost going to say that something tells me that you are referring to chemicals / pharmaceuticals, but you mentioned consumption. So sorry. Let's talk about consumption first.
So Niraj, add chemicals to that actually.
Achha, okay, fine. I wasn't completely wrong then. Okay. So, let's start with consumption. Nimesh, the overarching view all of 2023 was that consumption is in this K-shaped pocket, wherein the upper crust of the K, premiumization is doing very well and the lower end isn't doing well. The volume growth isn't coming, the pricing power is not there. There is local competition which is eating into pan-India players. Is that changing, or is that the consumption you're referring to?
So for now, it is not changing much. So this K-shape continues even till, say, the last quarter numbers that we see. We've seen a more premium and higher end consumption doing very well, the lower end not so much. Some reflection of that can be that rural has not done much and urban has done a little better. You would find areas like travel and tourism, hotels, these have done better than, say, the FMCG counterparts. Within cars, you see SUVs doing very well rather than very low-end cars. So that K-shape, frankly, continues till now, but there are green shoots of a bottoming out or pick up in the rural side, pick up in some of these other areas also. So we are actually looking very closely, keeping our finger on the pulse of the economy to see if there are any changes happening on that side. And because that's where market is quite pessimistic about, or market is not looking at any immediate trigger. So those are areas we look for, whether the valuations of these companies are attractive, whether the business can go back to growth. See, again, we just finished analyzing the festive season, but frankly, again, in 2 quarters, we'll be talking about the next festive season, the next monsoon season. And you can't say that because the last one was had a certain X or percentage of growth, next one will also be the same. So we can see some pickup there. We are seeing some green shoots coming in the rural side. So consumption is an area where we are looking for a pickup. In terms of chemicals, a lot of them saw some pricing pressure and volumes being under pressure because of inventory built up. Now it's a large space, though we have to look at company by company, but generally I can risk one generalization that there is an improvement across some of these chemical prices and volumes also, maybe a little bit of improvement, bottoming out kind of going through. But again, when you look at 2-3 quarters down the line or 2 years, 3 years down the line, these are some of the companies which are beneficiaries of PLI, beneficiaries of China Plus One, beneficiaries of global sourcing. So I think that's an opportunity there. Again, a small sector I'll add to this also, that real estate has just started doing well last year. We saw real estate possibly continues for the next 2-3 years. And when real estate grows, it affects so many different sectors positively, whether you look at cement and steel, positively on, say, tiles, faucets, some of these building materials that come in, wires, cables, consumer goods. So those will also start seeing an improvement. Right now, the market is not factoring in much from there, but that's where some of this opportunity lies. If you can pick up good brands at reasonable valuations, they can be your compounders.
Okay. Nimesh, just one quick follow-up, because we are out of time completely on the show, but do pharmaceuticals fit the bill as well, and underperforming sectors starting to show some turnaround?
Oh, absolutely. I think pharma sector has, again, some similar long way to go. Some part of the rally has happened. So I would say that US generics side of the business has got good discounting. I think people are now re-looking at some of the domestic stories, especially MNC pharma side. We are very much interested in contract research and manufacturing side. As we are expecting interest rates to go down, global funding for some of these small biotech companies or pharma companies is expected to go up. And India is a fantastic partner in contract research and manufacturing to many of these companies. So there is a lot of interest for them. So we picked up these smaller, we looked at these smaller pharma companies which are involved in contract research and manufacturing and have capabilities to take from kilo lab to tons. And those can be the dark horses, or those can be the areas where pharma can also be.
Nimish, so good talking to you. Thanks for taking the time out and being with us on the show today. Really appreciate your time.
Pleasure. Thank you, Niraj.
Thank you. And viewers, thanks for tuning in to this edition of The Talking Point.